Thanks for everyone to coming to this monthly webinar series. I'm Zhi Guo. This is for capital market development in China and Asia. Today, we're very happy to have Wei Xiong here to talk about big tech lending model. Wei was giving us the very first lecture as an opening seminar on this series, and we are very happy that he come back to talk about more detailed about one particular part. So Wei, you will have 30 minutes, 25 to 30. I would remind you.
It's a great pleasure to come back to give another seminar. So today I will use this opportunity to present this new paper on the big tech lending model. This is joint work with Lei Liu at the Chinese Academy of Social Sciences and Guangli Lu at the Chinese University of Hong Kong, Shenzhen. I think big tech lending, probably everybody already heard about it. So this is a new global trend. Big tech companies across the world now offer financial services to improve financial inclusion. The use of unique data and the integration of operations with digital platforms such as social network and mobile payment create a great new opportunity to offer financial services and make big tech lending even more powerful than other types of fintech lending that already had rapid growth across the world in the last 10 years. According to a recent report by BIS, the big tech credit volume may have been as large as half a trillion US dollar in 2019, which is at least twice that of other types of fintech credit, such as P2P lending and online mortgage lending and so on. So in some sense, big tech lending really represents the frontier of fintech. Many countries across the world have seen rapid development in this area, especially in Asia. In China, all the big tech companies such as Alibaba, Tencent, JD, Baidu, and so on, all offer some sort of lending services. In the US, Amazon, PayPal, eBay, Square Capital, Apple, Google all started to offer financial services such as payment and credit in the recent years. In South Korea, Samsung, Kakao, in Japan, tech companies are also doing very similar things. Even though these big tech lenders have to rely their lending on the particular models of their digital platform, nevertheless, there are quite some common features in the operations. They all offer consumer loans and also loans to small and medium enterprises. These loans tend to be small with very short maturity. So today, I'm going to use data from China's Ant Group, which is a subsidiary of Alibaba, to explicitly analyze big tech lending. Big techs are substantially different from other fintech lenders. They have extensive customer bases, powerful brands, superior data about the borrowers, capacity to monitor and even to control consumer activities inside their respective ecosystems. There had been a lot of interest about big tech lending in the last few years. However, due to limited data availability, so far, we still know very little about how do they operate. Prior work, actually a lot of work also used the data from the same company in China, have shown that the big tech lending facilitate financial inclusion, support the small medium enterprises, and stimulate entrepreneurships. In particularly building on connection to mobile payment, which had made a lot of progresses in China. But nevertheless, some key questions still remain to be addressed. Is big tech lending riskier than bank lending? Is big tech lending robust to severe economic shocks that create structural breaks to the risk models used by big tech lenders? These are the key questions that worry regulators, right? As many of you know, Ant Group's IPOs, which could have been the largest IPO ever, right, was suspended at the last minute, actually largely due to concerns about potential risk, right? So in that sense, these are still a kind of open question and that need to be carefully examined. So how do big tech lenders manage the risk, especially given that they are lending to borrowers actually who typically lack regular access to conventional bank loans, right? To the extent that banks don't want to cover them, big tech lenders cover them to their face risk, right? What kind of risk and how do they manage such a risk? So these are still sort of the key questions, so which we will try to address. And also we wonder, right, what do these borrowers use big tech loan for, right? So which is also unclear at this point. We're going to focus on lending by MyBank, which is a subsidiary of Ant Group, which owns Alipay. As many of you know, this is the largest mobile payment system in the world that serves over 1 billion users. Ant Group also owns MyBank, which is the pioneer big tech lender in the world, which had already lent to over 35 million small medium enterprises, which lack credible financial statements and records for traditional lenders. Many of MyBank's borrowers are merchants who use Alipay or online vendors on Alibaba's e-commerce platforms. Unique extensive data about each borrower's business, such as payment flow, cash flow, customer ratings, information about firms, along its business chain, digital footprints are all made the lending of Ant Group and MyBank particularly interesting and potentially powerful. It's also important to recognize Alibaba's ecosystem can also potentially help MyBank to monitor loan use and repayment and so on. It's also interesting to see that MyBank, which different from a traditional bank, is often constrained in funding because it does not collect deposit and thus face much higher funding costs than traditional banks. For that reason, MyBank began to collaborate with the traditional banks to provide syndicated loans since June 2018. In fact, actually, our data comes from one of its co-lender, which we call Bank X. In this syndication program, MyBank is responsible for acquiring borrowers, assessing risk, processing loan applications, and determining interest rate and credit limits. When MyBank identifies a potential borrower, MyBank will send the loan application to Bank X. Bank X can choose to accept or reject the loan application, but most of the time cannot determine the interest rate and the credit limit. So basically, Bank X's role in this syndication is to provide the funding, actually most of the funding. On the other hand, MyBank carries most of the rest of the work. MyBank is also responsible for managing the loans after origination, such as collecting payments, and if this default, how to go after the borrower and so on. A little bit background about the co-lender of MyBank, Bank X here. Bank X is a large commercial bank with national coverage across China. It also has a specialty in lending to small businesses, has an extensive loan syndication program with Ant Group. In fact, it is one of the largest co-lender of Ant Group. It's useful to mention that the Bank X also has 2 lending programs of its own, which we will compare with the Big Tech lending program. First, it has its own regular loan program. Basically, borrowers file application at the local bank branch, and which will the application will be assessed by loan officers in person. So the process may take a while, and as you will see, this program heavily rely on collaterals. Bank X also has an online lending program because of the ongoing trend, right? FinTech lending. Bank X also trying to modernize its loan application online. Basically, a borrower can apply online, and the bank assess the application based on a variety of traditional and unconventional information through machine learning models and so on. So this is where, in some sense, this is also a FinTech lending program, because Bank X also collect unconventional data together with its traditional data, and they use machine learning models to assess risk. The process of this online lending program is faster, but still may take half a day. And as you will see, I will show you some data later. This program tends to pre-select a group of highly qualified borrowers with excellent credit history. And as a result, this online lending program also rely less on collateral. Okay, so basically, I'm going to compare loans made by these 3 programs: Big Tech lending program of my bank with Bank X, as well as the regular and the online lending programs of Bank X. I'm going to summarize some basic findings. Let me quickly mention here. The Big Tech loans actually are not more risky, despite they tend to have a higher interest rate, and also the borrowers have lower credit quality. And also we're gonna try to summarize some basic features of this lending program. The Big Tech loans are used to meet, interestingly, they're used to meet the short-term liquidity needs, because we see that the borrowers repay quickly, far before the maturity, and borrow frequently. I'm also going to trying to highlight some mechanisms for the Big Tech lending program to avoid too much risk. The standard mechanisms such as screening and monitoring. But I want to particularly highlight 2 unconventional mechanisms: convenience and the interest rate, which work together to attract borrower or to screen borrowers with short-term liquidity needs. All right, so very quickly, our data. We obtained some proprietary loan data from Bank X. These are loans originated between August 2019 and December 2020. Nice part of this data period is that the COVID pandemic actually occurred right in the middle of this period. The main sample covers a 10% random sample of borrowers with business loans in 3 groups. I should particularly highlight that we only analyze business loans, not consumer loans. We have 3 sets of loans from 3 different programs. 840,000 Big Tech loans. So these are loans made by the syndication program of my bank and Bank X. As well as almost 35,000 regular loans made by Bank X, and 113,000 online loans made by Bank X. Even though our data sample is short, but we have a large number of loans in the cross-section, which allows us to draw some interesting comparison. We also have a small overlap sample. Some borrowers, actually, a small number of borrowers, several thousand of them, borrowed actually across these programs, which actually allow us to compare actually loans obtained by the same borrower from the big tech lending program, as well as these two other conventional lending programs. Let me first highlight the
just
main sample.
reminder of timing, about 10 minutes.
Only 10 minutes? I should be really quick.
Yeah, only 10 minutes.
Really, I use already 15 minutes?
15.
Okay. So our main sample, there are 3 sets of borrower. The big tech borrower tend to be much younger, 33-year-old. They also have from much more diverse background. 38% have college degree, much higher than 2 other programs. They also tend to come from the rural area. And some of the borrowers actually provided their credit report. And we can see that actually the big tech borrowers tend to be get their first business loan, and especially first uncollateralized business loan from the big tech lending program, much higher than these 2 other conventional lending program, which confirms sort of the early arguments that the big tech lending program tend to cover borrowers' lack of access to regular bank lending. And also, for those borrowers who provided a credit report, we find that the big tech borrowers, if they have outside credit, which tend to be much lower than borrowers from these 2 other conventional lending programs. All right. So in terms of long term, so we have a lot of loans, and there are collateralized loan as well as uncollateralized loan in the data, but for the big tech lending program, over 98% of them are uncollateralized. On the other hand, the regular lending program of Bank X tend to have 80% of the loans with collateral, which is consistent with what we know. The online lending program for Bank X actually also tend to have less collateral, but nevertheless, as we see earlier, they tend to have a lot of credit from other sources, which shows that they tend to be borrowers with excellent credit history. Okay. For our analysis, we're going to focus on uncollateralized loans because 98% of big tech loans are uncollateralized. So among all the uncollateralized loans, big tech loans have an average interest rate of 14.6% annual interest rate, which is about 6% higher than uncollateralized online loans and the regular loans of Bank X, right? And also, big tech loans tend to be smaller, and also substantially lower credit, and the loan size is even smaller. Average loan is only 8,000 RMB. So let me quickly get into a risk. Are big tech loans riskier than conventional bank loans from these 2 other programs? Prior research finds that P2P lending tend to be bottom fishing, and they tend to exacerbate borrower risk. Do we see the same thing in the big tech lending program? We measure a repayment risk by a loan being overdue for at least 30 days. We can just look at the raw data. Big tech loans had an average 2.6% delinquency rate, which is higher than these 2 other programs, 1.1% for online lending program and 1.6% for the regular lending program, Bank X. But on the other hand, they recognize that actually half of the loans in the big tech lending program actually had no prior payback history. So these are literally first loans. If we look at these first loans, the default rate is 4.2%. But on the other hand, if you look at the other half, actually, as long as a borrower paid back at least 1 loan, the default rate dropped down to 1.2%. So you can see that the risk actually really mostly lies with the first loan, which is directly observable. And in the formal regression result analysis, after controlling for some obvious observables, especially paying off the existing loans, there's no difference in repayment risk between big tech lending program and these 2 other lending program of Bank X. COVID happens in the middle of the sample, and this provides an exogenous shock examining whether big tech lending is robust to large shocks, right? In fact, actually, other studies already show that the P2P lending in the US and China during COVID crisis are clearly not robust, and clearly they are much worse than during COVID. During the COVID period, we see that the big tech lending program in our data actually is very stable. So this volume at the red line across February 2020, which is pretty stable, no fluctuation at all. But on the other hand, the regular lending program and the online lending program, BankX had a drop because this is the Chinese New Year, right? The seasonality. If we compare the risk for loans originated before and after the COVID shock, there's no risk. There's no difference. Actually, if anything, the big tech loan actually made right after the COVID shock actually is less risky rather than more. So this shows that actually the big tech lending is robust. So this raised the big question, right? How does the big tech lending program manage to make loans without incurring excessive risk to a pool of borrowers that a traditional bank are not willing to cover, right? So we don't think sort of any single mechanism can do the trick, right? So given that this is such a challenge, okay. So we're going to argue that a set of mechanisms like information advantage to screen potential borrowers and monitoring through the ecosystem and convenience and the high interest all work together. So first, let's think about the traditional monitoring and screening mechanism. In each of the lending program, the lender commonly approve borrower with a credit line with a given interest rate. So this allows us to make some simple adverse selection test, right? Big tech loans face more severe adverse selection than conventional bank loans. So the test we're trying to do, we're going to check whether those who choose to use up their credit limit are more likely to default later, right? So, so we're going to examine these three loans lending programs separately. Interestingly, for BankX's regular lending program, we find actually there's a positive correlation. Borrowers of this program who use up their credit lines initially actually tend to more likely to default later. And this is positive and significant correlation after controlling for the usual or whatever we observe in the data. But on the other hand, for the big tech lending program, after control for the other observables, there's actually a negative correlation in the sense that those borrowers who use up their credit limit earlier and actually are less likely to default later. So in a sense, actually, a big tech loans show advantageous selection rather than adverse selection. So of course, we cannot separate it. This could be because of screening or monitoring, but likely this reflects both, right? There's an interesting dimension which is not usually examined in earlier study, which is earlier repayment. How fast a borrower repay the loan actually can tell us quite a bit about what they use the loan for, right? If a borrower take a loan to finance long-term business expansion, it's unlikely for the borrower to pay back early, right? And also, if a borrower overborrow, it's unlikely the borrower will pay back early, right? It's quite interesting. In our sample, the big tech loans are actually paid back on average at the time, which is only 0.6% of the loan maturity, much shorter than the online loans and the regular loans of BankX. If you look at the distribution, the median payback time is only 28% of the loan maturity, and the 25th percentile is only 4%. So this is a very fast repayment, right? So if we control for the, in the formal regression analysis, just confirming the same thing. Big tech borrowers are much more likely to repay way before maturity. So this suggests actually these loans are used to meet the short-term liquidity need rather than for long-term financing, right? And of course, to the extent the loans are paid back so quickly, this also reduces the lender's risk exposure to the borrower's repayment risk, right? Okay, given the fast repayment, it's not surprising actually the big tech loan, the net interest expense per loan is actually a lot smaller, right, than the online loans and the regular loans of Bank X, even though the interest rate is lower on these conventional loans. And because of this is where the convenience actually kicks in, right? Because technology makes it very convenient for borrowers of the big tech lending program to quickly repay and quickly borrow and repay. In our data, we see that in a very short sample period, the big tech borrowers tend to borrow much more frequently, 6 times in the 18-month period, which is substantially higher than these 2 other programs. We have a small set of big tech borrower with access to both the big tech with access to Bank X regular and online loans. So this is a set of marginal borrowers. They tend to the extent they qualify for Bank X regular and online loans, they tend to have better quality, right? And that's why sort of you would imagine they're supposed to be borrowers the big tech lending program should compete for with the traditional bank, right? So do they get a better term, like a more competitive interest rate and higher credit limit? So we see about 600 of big tech borrowers had access to to Bank X other programs. Interestingly, the interest rate they get from the big tech lending program is still 14.5% on average, which is substantially higher than the loans they get from Bank X's online and regular lending programs. And the credit limit they got is also smaller, less than half. And the loan size, again, smaller. And so this raises a very interesting question. They didn't get a better term. If anything, they get exactly the same as the borrowers in the main sample. You might argue perhaps these borrowers have run out of credit limit from Bank X when they took a loan from the big tech lending program, right? Interestingly, we can also separate out the big tech loans taken when actually Bank X credit, a cheaper credit was available, and with whether they are available or not available. Interestingly, again, there's no difference in the interest rate, and the loan size also about the same. So basically, they're very similar, and the only difference is that those loans taken when cheaper credit from Bank X is available, they're paid back faster. So this actually confirms, this actually indicate, right? So why actually these borrowers, even though they have sort of a cheaper alternative out there, they still take the big tech loan. Perhaps because they anticipate themselves to pay back quickly anyway. So that's why, even though interest rates be higher, but if you are not going to hold on for too long, the interest expense is not going to be that high, right? Okay. We also did other stuff like risk and so on. So it's basically we get the same thing. So for the overlapped sample, they get high interest rate, the small loans, fast repayment. The high interest rate actually offer very interesting implication. So that means the high interest rate are not simply price discrimination, right? To the extent that the big tech lending program potentially need to compete for these borrowers, the program didn't offer lower interest rate. That means the high interest rate actually is not really simply price discrimination. Perhaps it's part of the overall strategy to induce advantageous selection, right? So here is we argue actually the big tech lending program offer the high interest rate actually to screen borrowers actually with short-term liquidity need, right? So borrowers with short-term liquidity need will pay back quicker, and as a result, actually risk is not high, right? Of course, to induce this kind of advantageous selection, you need to make the program appealing. This is where the convenience kicks in. Because this program is convenient and borrowers would like to use it, even at a little bit higher interest rate, right? But of course, they don't want to use this kind of loans for a year for long-term financing because it would be too costly. For short-term financing, actually, it's actually preferred, right? So as a result, the combination of convenience and the higher interest rate actually may induce this kind of selection. Select the borrowers with a short-term liquidity need rather than long-term financing or other kind of need. Okay, due to the time, let me just
we
wrap
need
up
to
here.
wrap up. Wrap up.
Okay, yeah, let me just wrap up. By comparing loans from this big tech lending program and the two conventional lending programs of Bank X, we find the big tech loans are not really more risky, despite their high interest rate and borrowers lower credit quality, right? So this is very different from other fintech lending, right? Like P2P lending and so on, which tend to be bottom fishing and tend to exacerbate borrower risk. We find that the reason there are potentially multiple mechanisms leading to this interesting outcome. So we find that the big tech loans are used to meet short-term liquidity rather than long-term financing needs, right? This is because borrowers tend to repay very quickly, far before maturity, and borrow frequently. We believe that the standard mechanisms like screening and monitoring are clearly present here. But at the same time, we also highlight the importance of convenience and also actually high interest rate, which is an unconventional kind of mechanism, right? So these mechanisms work together, serve as a new selection mechanism for borrowers with short-term liquidity need. The rise of technology and big tech lending leads to a very intriguing question about how technology might penetrate the financial banking industry, right? So how would actually big tech companies compete with banks for future financial services is still open question. From our data, we see that the current model actually focusing on financing of activities inside the lender's ecosystem and especially short-term financing, short-term liquidity needs, right? So in this model, actually, the big tech lender is not directly competing with banks for more general financing need. And of course, in the long run, big tech may need to adapt, right? Because the borrowers currently in the ecosystem may gradually graduate from this program because they will obtain a credit history and thus qualify for cheaper bank loans. Then the big tech lending program will have to improve itself, right? And they have to adopt a new game. And that time, sort of, you may have to directly compete with traditional banks, right? Then how these big tech lenders and conventional banks in the future may compete is still open question and may depend on data sharing regulation. I know Scully worked on this on some of the interesting conceptual questions, but how you play out also depends on how financial regulation put on these big tech lenders on the capital and so on, right? In that sense, both capital regulation as well as data sharing regulation are going to eventually determine the landscape of how big tech going to compete with banks. So let me end here. Thank you.
Thank you. Zeng Yao from Wharton will discuss this paper.
Thank you, Ziguo, for inviting me to discuss this super interesting and exciting paper. And I enjoyed reading it a lot. Okay, let me first echo away by showing essentially the same thing he showed at the beginning, which is the rise of big tech lending. We know that, I mean, we are super interested in big tech lending today, not just because those big tech firms are by themselves big, but also because big tech lending is getting more and more important in terms of its volume and economic importance. So this, I mean, it's very easy for us to motivate this overall research question. And we do expect, I mean, if you look at the volume of their lending, we do expect, I mean, increasing number of papers as well going forward. So what's the big part in the background when you think about the uniqueness of big tech lending? Obviously, I mean, they're not banks, right? But they're even more unique compared to the idea of fintech lending because they are not actually designed as, I mean, a finance company. And pretty much when we think about examples of big tech lending companies, we think of companies like Alibaba, which is the focus of this paper. And in the US, we have Amazon, Apple, who is going to introduce their buy now, pay later products pretty soon, and also PayPal. And if you think about those animals, pretty much they are existing technology-enabled ecosystems. And here I really want to highlight this, right? Because they're not designed as banks or lenders. They're ecosystems which aim for matching lots of merchants and consumers. It's basically a network. So when we think about that, right? So it's not exactly, I mean, unclear from a theoretical point of view why they can ever become banks. Because again, when you think about like big firms, right? There are a lot of big firms. Why? I mean, firms like an ExxonMobil, it's an oil company, or Coca-Cola. Why they cannot do the same thing? So there must be something unique about the ecosystem, about that network. And then obviously we see the pattern here. We see big tech firms have been increasingly jumping into the lending space. So the very interesting question is what's unique about it, why and how they can better lend compared to traditional banks and fintech lending. So there are typically two common narratives about the advantages big tech lending now. Number one says basically big tech lenders, they have superb information about their prospective borrowers because they can easily observe the payment flows, order flows, and they can use that information to better screen borrowers. And the second view goes like, I mean, big tech lenders, they also have better ability to direct seize money from platform activities. And this is exactly what Alibaba and also PayPal are doing today. They can directly withhold and apply a proportion of those merchants' daily payment inflows to repay their loans. So that also allows them to better monitor those loans. So those are like the common narratives about advantages. But obviously, due to the lack of data, there is very little direct evidence in the literature to really pin down and to pinpoint those mechanisms. So what does this paper do? That bottom line of this paper is paper thought-provoking and provoking because it provides us with a very comprehensive view about the nature and economics of big tech lending. So we have showed you a very rich pattern of the borrower characteristics and loan characteristics, and interest rates, long terms, size, and the repayment speed, which is pretty novel to the literature. I'm going to review some of the key findings later as I do my comments. But just to summarize the key findings in two pillars. Number one, compared to traditional bank lending, big tech lending is going to help achieve financial inclusion without suffering from excessive risk taking. In other words, they're going to help those so-called unbanked borrowers to get their first credit, but at the same time, they don't actually take too much risk. And this is also robust to aggregate shocks like COVID shock. This is obviously very interesting result because it does speak to the potential of the big tech lending model. And in terms of mechanism, so that's pillar number two, which shows that what's unique here is a convenience to use those big tech loans plus higher interest rates. So those are going to help big tech lenders to screen borrowers with short-term liquidity needs. So those are the firms who don't really care about, I mean, maybe they still care about long-term investment, but they are not really financial constrained about their financial long-term financial planning. But they're really they pretty much care about their working capital. So they go to big tech lenders and they can enjoy the convenience. They can get this loan pretty quickly, and that's going to result in an advantageous selection into big tech lending because at the end of the day, big tech lending reach their success by pretty much servicing this very unique segment of borrowers. So those are the key findings or the key interpretations of the findings. And I think the paper makes contribution in several important dimensions. Number one is its use of unique administrative data from WeBank. And also the Bank X in the background. So that means that we can compare different loan products from essentially the same bank coming from Bank X. In other words, we don't necessarily have to worry about the big tech lender having maybe a higher funding cost compared to traditional banks because they don't get access to deposits. That's not the case because essentially we're talking about the same bank in the background. And also they have this very nice sample of overlap borrowers. That means that we can even look at the same borrower and simply compare across different loan products. So that's going to give us a very unique results about the uniqueness of big tech lenders. And secondly, again, so I really like the new and surprising facts about the risk of big tech loans. And this is like not simply confirming what we know about big tech lending, but to provide us with something new. And also they provide interesting exploration of the underlying mechanisms connecting to several classic economics literature, adverse selection, monitoring, convenience, and selection market. I'm going to touch upon those topics later. So the bottom line is, again, given, the wave of new papers focusing on this important topic, I definitely expect this paper to set standards for a new literature. Now, as I think about my comments, I find this, this is not an easy job because not just because this is a good paper, but also because the comprehensive nature of this paper. Actually, the authors are very transparent and humble about this. They said it's just impossible to attribute big tech lending's success to any single mechanism. And typically, we view this as something.
10 minutes.
But yes. So I do view this as strengths rather than weakness of this paper, because I do think the value of this paper is just to provide a comprehensive view of the nature and economics of the big tech lending model, rather than to really identify something or to highlight something some single mechanism. And the paper has already done a great job identifying the mechanisms. So with that in mind, my comments is going to focus on the interpretations and to provide suggestions to hopefully better tighten the results under the same umbrella, with the goal being to bring the big part of economics even more front and center. Remember, we're talking about big tech companies and their existing tech-enabled ecosystems. So what's unique about those ecosystems? My first comment is about first question, how risky are those big tech loans? Here, and they're very transparent about this because the answer depends on how we see them. And big tech loans, they are safer, conditional on observables, not only the first payment record, but they are unconditionally riskier. So again, I'm not saying there's anything wrong about that, right? But when we try to reconcile those two, we already provide a view about this because this is all about the first payment record, right? So again, so this really speaks to the uniqueness of fintech lending of big tech lending to identify the good part of those borrowers. But one thing to think about is we can also say, okay, the risk may have been largely compensated given big tech's higher interest rates. Or in other words, if you think of big tech lender as investor and you look at the efficient frontier and you take a Sharpe ratio view and you compare that with traditional bank loans, big tech loans may well have a higher Sharpe ratio. That means that from a private investment point of view, there's no inefficient risk taking. But I'm pretty sure this is not something the authors want. This is probably too straightforward. I guess the more interesting question is why big tech, they go after the unbanked. This is related to another pitch of this paper, right? So does big tech help with financial inclusion? Because the benchmark is they could have simply rejected all the unbanked and gotten even lower unconditional risk. So here, what I would love to encourage authors to do is to perhaps do more tests to think about the two comprehensive to complementary views. There is a selection view, which means we can simply do more tests focusing on the subsample of those unbanked, those who actually apply the first loan from the big tech lender. And you can just look at those unbanked people. Maybe they're richer, maybe they're better educated. And they all speak to the nature of those people, right? So at the end of the day, maybe they're indeed less likely to default because they actually have a better type. And if data permits, maybe you can try whether those lenders, they have stable payment flows, even without credit history. Because again, they're fundamentally better on this ecosystem, even if banks don't understand that. And there's another complementary treatment view, which means you can also ask how does big tech do for those unbanked? For example, if firms, they successfully repay the first loans, maybe they're more likely to borrow repeatedly because now they get a ticket to go on the ecosystem and they can enjoy the ecosystem and they can make their business even more efficient and they can repay subsequent loans even faster. So that means that it takes those two views together and you can argue for a no access risk taking from a social welfare point of view, because at the end of the day, maybe there is higher default, but they may be largely compensated by the social benefits to battle the initial credit shock facing those unbanked. And then we can talk about the second thing, advantageous selection. This is obviously another thing very interesting because this is largely contrast to the traditional fintech literature suggesting fintech lenders are subject to adverse selection. So this fundamentally comes from the insurance literature, with the idea being those who buy more insurance, they end up spending more on healthcare, meaning those people know, okay, they're unhealthy, so they buy more insurance, they spend more, and there's adverse selection. And what this paper finds is that in the opposite direction, those borrowers who take larger credit limit, they take larger fintech loan, but they end up defaulting less. This is obviously very interesting, right? This suggests there's something unique about those big tech lending. So I would encourage authors to go a little bit deeper here to study the source of advantageous selection here. And again, you can maybe benchmark this better to the insurance literature, because the idea of this correlation test come from there, and we have papers showing that hidden risk could be correlated with people's behavior, because when you are more risk averse, you're going to buy more insurance, but also you're going to be more healthier, so you end up spending less. And Han Mingfang and his courses also famously detect advantageous selection in Gap, which is a premium version of Medicare. So basically that means you can buy a better version of Medicare. So that's going to allow you to get a lower copay and better coverage. And they see advantageous selection, but at the end of the day, they find that pretty much it's driven by richer people, better educated people, and people who have a longer financial planning horizons. And maybe that's the same thing, right, for those big tech lenders. So this is exactly something you can check in your data, and you can link that source to the big part. The second is something we already mentioned in the presentation, because the correlation test is essentially a joint test of adverse selection and moral hazard. And again, this is related to the insurance literature. People know that. We have been very transparent about this. But here, again, I build this as strengths. Why not just talk about those, right? There is advantageous selection, but there's also advantageous treatment. At the end of the day, big tech loans may allow firms to manage their business better, and there could be lower defaults coming from that. Something you could possibly check, if data permits, is whether big tech loans lead to faster inventory turnovers or payment flows, and that can essentially help those borrowers to do their business better. So here, again, I would like to keep both interpretations open and do what's feasible to detect treatment effect.
3 minutes.
Repayment, the same idea, yes. Currently, we interpret that repayment speed as capturing short-term liquidity demand, which I think is very plausible, and that does speak to something unique. But also, I would like to bring in this selection versus treatment view again, because when you think about repayment speed, that could be an outcome of taking up a big tech loan, because again, this is something different from other loan characteristics. This is something endogenous. This is something the borrowers are going to determine after use that loan. Again, the idea is they're going to allow firms to potentially manage their business better, and they can potentially repay their loans faster. Remember that this doesn't have to be related to their liquidity demand, right? So even if they use money to do some long-term financial planning, still, if they can do their business better, they can more efficiently pay their loans. So that does speak to both a selection effect and a treatment effect. So maybe again, so you can keep those two interpretations open and do what's feasible to detect both. At the end of the day, so since we're talking about both selection and monitoring, maybe there is a way for us to better ascribe those to something unique about big tech lending. So that's how I would like to link it to another key findings of this paper: convenience and the price that big tech lenders charge. This is a very convincing test, because it's based on the review preference approach. Even when those borrowers have access to bank financing, still they go for the more expensive big tech loans. The question is why? Now, as we think about that, right, so I would encourage authors to maybe come up with more direct proxies of convenience, maybe can look at loan processing time, or maybe can look at different reliance on online selling. And remember, right now we are talking about convenience, but it doesn't necessarily have to be something you're going to get currently, right? So because you pay more expensive interest rate and you get the ticket into the party and you get to enjoy future access to this ecosystem, and that's something you care about in the future as well. So that's also a form of convenience. So for that, I would suggest a possible rewrite. I will be very quick about this, and it's not actually against the current pitch, and it actually goes back to the very first fact that we shows. Big tech lenders, they pretty much do uncollateralized lending. So again, this is something the authors have been very modest. They basically show, okay, so this is the very selling pattern in the data, and they focus on uncollateralized loans. But I would actually encourage them to highlight this as a puzzle, because it's well known that traditional banks use collateral, and this is indeed true in the data too. And collateral does help with screening and monitoring. Remember, this is not against the current pitch, right, of thinking about how risky those loans are, because uncollateralized loans are indeed typically riskier. The question is how big tech lenders can potentially do better. Here's my story. Again, this is totally based on current results. Hopefully you can do better. So I suggest some potentials, but you can kind of reorganize your results a little bit, and the logic goes as follows. Number one, big tech loans, they carry an ecosystem-specific convenience, and borrowers want to get that. So big lenders, they charge a price for that convenience. Borrowers pay that price. They pay that high interest rate, but that allows them to get access to the current convenience. They get the 310 loans very quickly, and they also get the future access to the ecosystem. In the future, they can get loans even more fast and quickly and easily. And that means that in the future, the fear of losing those future convenience may help screen in the right borrowers and improve their repayment abilities. And that's exactly how you can potentially solve the puzzle. There is no collateral, but the convenience those currently and future convenience implicit form of collateral. And that's actually related to a large econ literature talking about the importance of access to future contingent claims in motivating agents' defaults and their repayment behaviors. And I would love to encourage authors to link it to that literature as well. All right, let me skip this and conclude. I like this paper as a very comprehensive and important paper on the economics of big tech lending. I expect many follow-up papers. So I really encourage people who are interested in banking to read this paper. And what I do here is to suggest a slight rewrite of the paper to hopefully further tighten the uniqueness, but I will optly leave this choice to the authors, and I look forward to the next version.
Thanks a lot. So now we want to open to the floor. Given time, let's just collect a question first. If anyone would like to ask.
May I just ask some very simple clarification?
Yeah,
there's a very important slide that there were overlapping borrowers, some with available credit lines, some without. I was slow. I hope that Songwei and his team can clarify again the result based on those overlapping borrowers. The second question I have in mind is about what was the difference in getting the loan? My impression is that in a big tech it is half a day, but if I go through a regular bank, it would take a week. So I want to know if this duration of return or repaying is really less than, is really just a matter of days or a matter of more than a few weeks. You know, I feel that is very important. Then there's one thing that I'm just puzzled. I mean, all these big tech borrowers are SMEs, and they may have liquidity need, and therefore they go to borrow and take advantage of the convenience, as you said. But collectively, they are not riskier. So it means that there's a body of borrowers that are paying a high price for their needs. and they are SMEs. Does it feel like the traditional banking literature that the SMEs are being discriminated against, or actually is about the market has not reached an equilibrium? There will be, like you said, there will be more players in the future coming in, and so there will be equalization, meaning that there's liquidity need. The SMEs, they do not have to pay a particularly higher interest rate to borrow because they actually can repay. The credit risk is the same as everybody. They are not being taken advantage of.
Okay, thank you. Boshan, can you just collect one more question and then let Wei to respond?
Okay, thanks a lot. It's just, I would like to echoing what Bernie just said. In fact, I like the convenience hypothesis a lot. And in fact, I have a personal experience that is, although I have paid off my housing mortgage, but I was like, I keep delaying really go to the bank to write off my mortgage. So even though now I'm not owing bank any dollar, but my apartment is still under bank's more collateral. So I think I buy the effect on early repayment a lot. Yeah, in fact, I'm willing to pay a little bit higher interest rate if everything is paperless. Yeah.
Okay, Wei, you can just give an overall response.
Okay, I will respond to both the discussion and the questions. I think my co-author is Guangli or Lei. If you want to add anything, you can add later. So first, thanks Yao for a wonderful discussion. I think Yao raised many fascinating issues. Some of that actually I need to digest a bit more, but I kind of get the big question. Seems like Yao still has some sort of it's really about the why, sort of what really sort of is the convenience and the why, right? What's special about the big tech? Sort of I think sort of I share the same kind of a concern, right? So not the concern, the same kind of question, in a sense. When I look at the data with Guangli and Lei earlier, we actually, we had the data from Bank X. We didn't get the data from N Group. So we don't have a lot of these borrowers sort of business activity kind of data. So we cannot really get into that. That would be actually really helpful if we could actually sort of highlight it a bit more clearly exactly sort of the convenience. Where is the convenience, right? So I think this is sort of the one of the key questions sort of Yao is puzzling about. I think sort of I mean, perhaps I should sort of mention a little bit more, because this is also what Paul and Bernie was kind of asking later, is sort of in terms of, because they're paid back so quickly, right? Even interest rate is 6% higher, but that's per annual, right? So for most of the borrowers here, they pay back their loans way before 1 year, right? So then the interest rate expense is not really that much higher. And I see sort of in the chat box, there's a question, so the loan tend to be small, right? Yeah, which is true. So loans here on average is 8,000 RMB, right? Which is not a huge loan. I mean, of course, the borrowers here, they are not the big business, right? They are these online vendors. They do sort of small shops selling small merchants. So this is really sort of for this kind of loan, sort of, you pay 6% per annual higher interest rate. In the end, the difference in the interest rate net expense is not, it's just a few hundred RMB, and maybe even less than 100 RMB higher, right? So it's not a huge difference, right? So again, so this is, in that sense, this is what's special about big tech lending here. They're lending to a lot of people. There are 850,000 loans with this one calendar, right? There are actually a number of other calendar out there. Sort of in a very short period of time, they made a lot of loans. A lot of their small loans, you know, they pay back very quickly, but then keep making a lot of these small loans, right? Each loan they don't make a lot of money, but on the other hand, the business can be viable and profitable because the volume is huge, right? So I think sort of this is the, and also from the borrower's point of view, right? If I'm just going to take some small loans, so instead of go through this procedure in the bank, even when I have this credit out there is cheaper, but on the other hand, I may have to go to the bank branch, or even if it's online, I have to wait a few hours for money to come in. But if I can actually get the money immediately in the platform, right, which you know these borrowers are probably in the middle of handling some transactions. If the money can come in a few seconds, this can be very nice, right? Instead, I wait for 2 hours. Even if money come, I have to redo my process again. That can be very annoying, right? So I think sort of this convenience is kind of quite obvious, right? So you know what I mean? Because of the cost, we're not talking about the huge interest expense difference there. Right? That's why sort of in the overlapped sample, even when these guys have the cheaper choice, they might still often end up using this anyway because it's easy, right? And I expect I can pay back later anyway. But on the other hand, because of, that's why sort of this model is special in my mind. That's why I'm saying with this model, currently this big tech lender is not competing with traditional banks, right? Because traditional banks want to make larger loans. They don't want to handle all these small borrowers a few thousand RMB each time. So this is going to be a lot of paperwork. It's not worth it, right? So
Wait,
I think
can I just to clarify one thing? I remember I asked you because you were talking about this convenience so much. If a borrower, let's say, you know, keep borrowing short term, then as if that he keep paying pretty big interest rate. So is this will be useful to confirm in the data indeed that the guy is basically borrow once per month, and then basically 7 days, only pay 7 days interest per month, something like that.
Yeah. Of course, they only pay 7-day interest.
No, a month. It's like, you know, I borrow for 7 days and then do not borrow this short-term loan again. Then next month, do 7 days again. Because otherwise, you're always keeping, you're always paying 7 days, and then the interest rate is quite high, right?
No, why was it quite high? Because it's
you keep rolling over
higher per annum. If you use, say, cover half a year, it's only right. If you 7 days in a month, every time it's just you're going to use a quarter of a quarter of the year, right? So then your interest will be
but if you keep borrowing, right,
then will be 1.5% higher, right? In the end, right?
I think the point is like if I borrow from Songwei only once and pay back in 2 days, it's very different from Bernard Yang borrow from Songwei again and again and again for the whole year. And each time I pay only 2 days. When you look at this from one shot into the collection of shots into the whole group, then and if you say that the whole group's risk is the same as the online, then why are they charged higher rate?
I mean, it's higher, but it depends on the duration, right? I mean, net borrowing period. Even the net borrowing period, you can add up all the effective days you need the funding for, right? So if you need half a year, then it's 3% higher, right? So I mean, it's 3%.
But Zhiguo's question is like, are they repeated borrowers doing the same thing throughout the year?
Actually, we could easily look sort of. I mean, so if I can share the screen again, I can show you sort of some of the stuff. Do I have that? Oh, I already.
We're running the time a little bit, showing it.
Anyway, let me go through that.
But I think it's very clear about the question now. So anybody else, Jin? Yeah, Jin.
Hi, Wei. I
Go
was
ahead, Jin.
looking at your figure 1, well, the only figure in the paper. So it says 10% of the 10% random sample. So does that mean the offline loans, the regular loans are so low for that bank X? So the bank X has moved on to issue more online loan and the big tech loans relative to the regular loan. Is my reading correct?
You mean why this number of conventional loans so much smaller, right? The number is smaller.
Well, the number is smaller, but on that plot, it means that the overall issuance size is also much smaller relative to the.
I think this is the measurement. This is the measurement. It's not the smaller.
This is the number
mean the
of
figure
the
1, right?
dollar. It's in IMB. So these are the size, the dollar size, the IMB size of the loan.
Right.
So this bank
they're not
has
a
shifted
lot
towards-
smaller. They're consistent with each other, and also this is the volume, right? The big tech loans are paid back very quickly, but the conventional loans are held to the end, right? So in that sense,
I understand, but still overall, the reason why I'm asking is the borrowers might vary across different samples, but the bank is always there. So I wonder if a more interesting angle is to look at the incentive from Bank X. So you think about Bank X, it's issuing regular loans, online loans, and a joint venture with the big tech. So what is its incentive? Where does it make most of the profit?
what's the
if you look at
incentive
the
for
time
Bank
series
X to
variation-
join this syndication? You mean?
Right, I wonder how much, in terms of the bank's priority, where does it want to move its loan, in which direction?
Right.
And the
I think
online
so.
versus the big tech is also
Right.
interesting. Is that bank having a joint venture with with Ant, and so that it can develop its own online lending in-house to kind of early stage a joint venture to learn about the the big tech model? Because you look at the interest rate distribution. I look at the table when you have a histogram, not a histogram, just a distribution of the interest rate. You can see it very much copies the big tech model. While the regular loan, the interest rate distribution is much more dispersed. While the online interest rate distribution is not that sensitive. I mean, it doesn't vary that much. So I wonder if from the big bank, not big bank, the Bank X perspective, it's kind of, the online model versus the big tech lending model might be more similar, and it might be mimicking the big tech model.
They are not similar, actually. They are actually quite different. Let me try to respond to you. First, the big tech. First, what's the incentive for Bank X to join this syndication? I think sort of to the extent that it has some capital, free capital on the side, lending it out without much risk is still kind of you make your money work instead of sitting there, right? So in that sense, it's still preferred, right? And also I should mention, my bank actually has several hundred syndication partner out there. So in some sense, if there's sort of a long sort of application here, I believe it's worth making. So if Bank X doesn't take it, so you can forward to Bank Y, right? So in that sense, sort of there's a host of potential fund providers out there. So I think that this is, you mentioned the sort of another interesting incentive is in some sense sort of to know more about these borrowers, right? I think actually there's already some evidence out there now that showing that actually the borrowers in this big tech program eventually will graduate, because after a period of time, because they know, right? So in my data, we already showed that after first loan, right? So risk comes down dramatically, right? Really is the first time, so it's the tricky one, right? I mean, it's not surprising, right? So before anybody paid back a loan, so these people are really uncertain, right? So in that sense, so for a traditional bank actually participant in this program, this is also a way actually to get to know these borrowers firsthand, right? So because eventually they can potentially pick them up, actually, I think, and we already seen that actually. So that's also, I argue, eventually Bank X, sorry, my bank would have to upgrade this game as well, because you know, now there are sort of all these millions of unbanked borrowers out there, right? But eventually, you know, after a few years, they might actually all graduate from this because they will have credit. Whatever the history they establish with my bank will become part of their credit history for future, right? So I think sort of, and perhaps this is related, also related to Yao's question, sort of, you know, there's a bit of a, in what sense, this is sort of a new form of collateral out here. Right, in some sense, this is also a way for these borrowers to quickly establish their credit history, right? So that also is going to be very appealing. So I mean, so my understanding is my bank here pre-screen borrowers. There are millions or hundreds of millions of potential borrowers out there in the payment system, right? So my bank can actually actively reach out to them. That's how it works, right? You actively send out the invitation to these pre-screened borrowers that you are qualified for a credit line. So some of them will pick it up, some won't, right? So of course, so for these highly qualified, they are, you know, borrowers, potential borrowers, they also receive invitation. They may not pay attention at all. If I already have much cheaper or better alternative, I may not pay attention to this, right? But on the other hand, for those really lack of access, they will pick it up, right? So they come in. So for them, actually, they might appreciate this. And this may be what Yao mentioned as sort of the ecosystem specific collateral or something. I mean, in that sense, you could argue that way. So and it works similarly, right? Because they do appreciate the sort of to have this access now, right? Not only in the payment system, but also sort of the credit. And in some sense, if they can do well after a few rounds, they can really have a bigger space later. I think sort of I think this clearly is here, and also in that sense, sort of I mean, from my bank's point of view, facing this larger group of uncertain borrowers, right? You know, it's not easy to make all these so many loans to these people. Nobody else wants to touch for now, right? So I think so that for now, I think it makes sense, right? Give them small loans, even charge their high interest rates. This also will let them pre-screen, right? So those actually really sort of, you know, they want to sort of use the money to gambling or doing other crazy things, unless they want to screw up this access, right? So they probably, you know, they need to challenge it if they really want to challenge this, right? So they will actually come in only when they have short-term liquidity, right? Rather than pay 15% per year, which is very high expense, right? Right? Often you don't have such a great opportunity to justify 15% a year interest expense, right? Then for some 1 month or 2 months, you know, take it and pay back is not a bad idea, because not only I serve my liquidity need, and also I establish the credit history, so then improve sort of access to financing later, right? So all of this I think is working. And in that sense, high interest rate, at least for now, it works because I mean, first screening is necessary, right? So the big tech lender need to do some screening initially, make sure you're not finding those crazy guys, right? Who is addicted to something and really need to borrow money to cover that. And if you find some reasonable borrowers, charging them high interest rate, also let themselves screen, right? So you come in not because you want to take a highly risky project, and if that doesn't work, you know, in a year the guy may never be able to pay back, right? So these loans, no matter what, going to be risky. Yeah,
we really have
too much.
no, there's a hotline, hot stop here. Like
Okay.
already 15. So thanks Wei and Zeng Yao for such an interesting paper and a discussion. I want to just tell everybody next month, November 17th, going to be Lauren Brandt is presenting serial entrepreneurship in China. and Hui Chan from MIT will discuss. So we hope that to see you next time. Thanks again, Wei and Yao.
Thank you, Zibo, for
Thank
the
you.
invitation, and thank Yao and everybody for the wonderful discussion.